All right. Today is Monday, May 19th. Excuse me. I'm sorry. 29th. It's been a long night. Welcome again, all of you all-nighters. This is part number 2 for market coverage because we got part number 1, lots of commentary, lots of analysis. Please check it out and then come back here and finish the show. But if you've already done that and you watched part number 1, welcome to part number 2 and let's just get right into business, folks. We start with the closing of the indices on Friday and here we go. The Dow Industrial Average was up in the green by 328.69 points, or a gain of about 1% even. The Nasdaq up by 277.59 points, or a gain of 2.19%. The S&P also positive by 54.17 points, or a gain of 1.30%. When we look at the sectors all in all on Friday, everything is in the green. Nothing to see here. Low volume day, lots of call options. 3-day weekend holiday, you know the deal. The path of least resistance is higher. Yet when we look at the weekly performance of the sectors, the evidence is clear. You got technology and communication services, aka the AI mania, working, and the rest of the market is sick. Metals are down 3%, defensives are down about 3%, healthcare down 3%, utilities down, everything is down. This is a bull market, give me a break. We'll look at the breadth on Friday. All in all, the NYC 68% advancing versus 30% declining. The Nasdaq 61% advancing versus 35% declining. Positive breadth, but then you look at the Nasdaq and the Dow and the S&P all up big, over 1%. But the breadth is not really that impressive, at least in the Nasdaq. And the reason is the big caps, the big guys, the AI mania doing the heavy lifting. We look at futures on Friday. Here it is. The dollar was flattish, and therefore we saw a lot of commodities moving higher. Be it energy, crude oil, WTI, Brent, all up about 1% for the day. Positive day for heating oil too, up about 0.75%. Then we have the losers on Friday. Gasoline, RBOB down about 3%. Nat gas down about 2.25%. But folks, the most important development in the oil market right now is what's going on with Saudi and Russia. This is not sustainable. If Russia continues to flood the market with cheap oil, then at some point, Saudi Arabia is not going to be able to tolerate that anymore. For now, what they're doing is exporting their own oil to Europe, for example, because Europe is not buying Russian oil. And then Saudi is buying the cheap Russian oil for domestic use. And for now, this is working for them. But if oil prices go below 70, for example, they're going to have a major problem. And if you noticed in the last few weeks, Jake Sullivan, who used to do DoorDash for the White House, now all of a sudden he's a big shot national security advisor. But he traveled to Saudi Arabia a lot recently. And the point was, hey, Saudi, be careful of normalizing ties with Syria's Assad, because we don't like that guy. And you're getting a little closer to Russia. So the Saudis said, thank you so much for the feedback, now get lost. And they got Assad anyways for the Arab summit. But at the same time, they hit 2 birds with 1 stone. They also invited Zelensky of Ukraine. What is the message behind that? Number 1. Hey, Jake Sullivan, Biden administration, you're pissed off because we're getting Assad to the summit? Well, we got your boy Zelensky too, so shut up. Number 2. Hey, Russia, are you watching? Because we have our limits too. If oil prices go down too much, we might give some cash to Zelensky in Ukraine, and you're not going to like that. And to me, this is really the most important development in the oil market right now. How will Saudi Arabia deal with what's going on with Russian oil? Theoretically, they can start another price war and flood the market with their own oil, and this is going to push prices down too much. We're going to go down to the 50s, 40s. And of course, the Biden administration would love to see that, but can Russia do anything about a price war? The answer is not really. If there is a price war, they will continue to flood oil anyways. They need the cash, whatever cash it is. So the other choice for Saudi is to cut production dramatically. Sure, that's going to make them lose some market share in India and China, but it's going to lift oil prices higher. But the problem is it has to be unanimous between OPEC Plus, at least the top countries. And if it happens, we could see oil blasting above 85 to the 90s again. So we have a potential for a lot of volatility coming in the oil market. Then we look at other commodities on Friday, look at softs. Again, the rise in sugar prices is absolutely alarming. They're up again, at least on Friday, up over 2.25%. You're going to feel that. You're going to feel the pain when you go to the grocery store and buy anything with sugar in it, which, by the way, might be bad for companies like Coca-Cola and PepsiCo, as they have to pay more for sugar. And then we also saw cotton futures exploding higher, with gains of about 4.5%. OJ did pretty good, modestly at least, up about 1%, and of course the losers, led by coffee, down about 1%, and then we got cocoa and lumber futures down, about half a percentage point apiece. The dollar did not do anything on Friday, and it appears that it's going to go down now, at least in the pullback. This is going to be really good for copper. You can play this buying the FCX. We saw copper up about 2.25% on Friday. It's going to be good for silver too. You see silver up. Gold might start to catch up too. We look at meats, no notable activity here except lean hogs down about 3% for the day. And then we got grains, a rebound across the board. Whether we're talking about wheat, corn, soybeans, rough rice, oats, all up handsomely on Friday. When we look at the options market, what do we see here? Explosion in volume. The volume exploded higher, and guess for what side? Buying calls. Classic sign that the retail mom and pops are now jumping in. Classic sign that the reversal is imminent, and these mom and pops are about to hold a massive bag. The hottest table by far on Friday is Tesla, with about 4.5 million contracts traded alone that day. About 63% of those were calls. No surprise, Nvidia at number 2 with around 1.8 million contracts traded on Friday. About 63% of those were calls. Amazon at number 3 with around 1.7 million contracts. About 66.5% of those were calls. So we see the FOMO, the stampede kicking in. The mom and pops, they're not really chasing buying the shares, they're chasing using call options. Safe for now, but my hunch is a lot of the retail mom and pops, their entire account is options trading. So they're going all in, and if it works, it works. If it doesn't, it doesn't. But it's a classic sign that we're about to go down because the retail mom and pops, the Johnny-come-lately, now they're catching up on the bid. The institutionals already shot up higher. They already bought ahead of time. Some Johnny-come-latelys in the institutionals responding to clients crying on the phone saying buy AI. They have to hold their nose and buy it. But this is a classic sign that we're about to reverse course. We look at the unusual activities that took place in the options market on Friday, and here's an interesting one for the Qs. Somebody's buying protection here, the 330 puts for the expiration date July 7th. And the expectations are that the Qs will go down and lose more than 5% of its value by then. They paid around $3.40 a piece to enter this trade, all in all spending about $17 million. This is not a joke. They see a reversal coming. They're hedging for it. Then we got a put spread on the SPY. They bought the 365 and sold the 335, all for the expiration date July 7th. And my hunch is this is the same trader. They're hedging a portfolio. They paid about $1 a piece for the 365s, received about 50 cents a piece for the 335s. All in all, the entry costs reduced to about 50 cents a piece, which brings the total all the way to about $1.5 million. What about the SQQs? This is the inverse index of the NASDAQ, the Qs. They're buying calls on it with the expectations that the actual Qs is going to reverse down. In this case, they bought the 24.5 calls for the expiration date June 16th, with the expectations that the name will go higher and gain more than 7% by then. They paid about $1 a piece to enter this trade, all in all spending about $500,000. And then we have a put spread on Tesla, but you gotta be careful with that because the spread between the bid and ask on Tesla is really wide, and you're paying too much for these options. In this case, the trader bought the 170 puts, sold the 150, all for the expiration date July 7th. Notice the theme here. It appears to me that one trader is hedging their entire portfolio. They're long Qs, they're long SPY, and long Tesla, and they're taking advantage right now by hedging their portfolios. Anyhow, they paid about $5 a piece for the 170 puts, and they received about $2 a piece in credit for selling the 150. All in all, the entry cost is reduced to about $3 a piece. That brings the total bid for this trade to about $4.5 million. And then we have the ticker POOL, P-O-O-L. We've been seeing a lot of bearish activities in this name. You look at the chart, the monthly chart, classic head and shoulder formation. This thing is about to go down even more. And somebody bought the 300 puts for the expiration date, July 21st, with the expectations that the name will go down or lose more than 8.5% of its value by then. They paid about $10 a piece to enter this trade, all in all spending about $5 million. And then lastly, we have the trade for the ticker SLG, Silver Green Property Commercial Real Estate in Trouble, in Distress. It's just a matter of time before it blows up. If you look at the chart for this one, the weekly chart, it doesn't look pretty good. It is holding for now, perhaps a bear flag. The momentum is exhausted to the downside, so we could see rebounds on the daily. But the trader here sees SLG going down, and they bought the $20 puts for the expiration date, July 21st. with the expectations that SLG will go down and lose more than 9% of its value by then. They paid about $2.30 a piece to enter this trade, all in all spending about $2.2 million. On to the heat map analysis. What do we see here? Daily chart, really mixed, mostly in the green, but it was a low volume day. It was a lot of short covering. It was a lot of one-way street, if you may, due to call options and the long holiday. But you see that the majority of the positive action is dominated by the big caps and the AI mania in chips, in the metas of the world. But you see, interestingly, we started to see some of the high dividend names moving higher, rebounding on Friday. You look at AT&T, for example. You look at names in industrials, also rebounding. Some names in utilities started to rebound by the end of the day. So we have signs that we might see the high dividend paying names moving higher this upcoming week. We contrast the picture with the weekly heat map. Again, here it is. Ugly across the board. What's working? The AI mania, the big caps, the Microsofts, Amazons, Teslas, Metas, and then the AI mania in chips. That's all there is. We look at 1 month chart, same story here. It gets even uglier. The exception is Eli Lilly. That's due to the weight loss mania. It is limited right now. Eli Lilly, NVO, and he got Pfizer joined recently. We'll see if that's going to stick or not. But the rest of the market, ladies and gentlemen, is sick. We look at a 3-month map. Same story here. A little better, but the majority of the gains are concentrated in a handful of names related to the AI mania. The rest of the market is doing really badly. And this is not what a classic bear to bull reversal looks like. We'll look at the heat map, the weekly heat map for the ETFs. Again, pretty much everything is down. Healthcare down, defensives down, small caps down, commodities down, international markets are down. What's working? KRE, short covering rebound, and then you got technology, the AI mania, XLK and chips, be it the SOXX or SMH, doesn't matter. Besides that, there is nothing to see here. So let's do some charts and then wrap it up. We start with SPY, the S&P 500, 30 minutes chart. What do we see here? Way overextended now at 420, which coincides with 4,200. Interesting number. You look at the RSI, the MACD, way overextended, due for a pullback. I would not be surprised if we go back to 416 and retest that support. Of course, we have a soft support before that, which happens to be 418. So I'll be watching for 418. If it holds and we have a rebound, in all likelihood, we're going to go above 420 again. But if 418 doesn't hold, then you can do a day trade to 416. That would be a safe assumption. We look at the daily chart for the continuous contract for the E-mini futures. We got all the way to 42.32, the resistance, at least in the overnight session. Is the SPY, the S&P 500 overbought? The answer is not even close. And the hope is, if you're really bullish, the hope is that we see a rotation. We see the Qs pulling back, money coming out of the AI mania and moving into chasing cyclicals, metals, oil, financials, industrials, consumer defensives, and most importantly, the cyclical side of the economy. Airlines, hotels, casinos, because that would be a classic sign that we have confidence by the firms and money managers that this is indeed a beginning of a bull market, and we're going to have the soft landing. But the fact that the institutionals are concentrated in the AI mania and the big caps, that doesn't give us any confidence that this is indeed a bull market or a beginning of a soft landing process. We need to see the rotation. I'm waiting for it. I'll keep an open mind. But right now, the majority of the move in the SPY is happening due to the big caps. We look at the cash index, and here it is. We made a higher high and a higher low, and then the process stalled. And now we're stuck within a range, 4,100, 4,200. Which way is it gonna be? The AI mania is topping off. So the only way the SPX is gonna move higher if we have a rotation from the year-to-date winners in the AI mania and the big caps to the laggards of the year, the cyclical names. Absent of that, it's just a matter of time before we break 4,100 as support. And if we look at the SPX from the weekly chart perspective, is it overbought? The answer is not quite. The RSI is still in positive divergence. We could see the SPY moving higher. The problem is we need participation from the rest of the market. You look at the monthly chart, not looking that exciting at all. Still in a consolidation wedge. I would say a bearish consolidation wedge. We need to see more here. But this chart is running out of time. If it doesn't start to perform and make a higher high, meaning above the August highs from last year, just like the Nasdaq did, then it's just a matter of time before we see a big flush down that breaks this consolidation wedge. We look at the Qs, 30 minutes chart. What do we see here? Way overextended on the RSI, the MACD. It's due for a pullback. The good news is it got plenty of support at 345.58. If that doesn't work out, then we don't have a lot of support between 334 and 345.58. So if that's broken, we could see a flush down prices all the way to 334.42. And I would not be surprised for us to even go down and close the gap below 334.42. We look at the daily chart for the NASDAQ. What do we see here? The futures. It is right now, at least at the time of the recording of this video, it is trading at almost my number. You see that resistance? I did not place that right now. It has been here for a long time. It appears that the futures is not going to make it above this number. It might consolidate a little bit, but it needs more and more energy to crack above this number. We talked about 14,000 as sticky, which means we have to go down in a retest of 14,000. You can't just cheat on an important number before a 3-day holiday, low volume, lots of call options, and consider that a crack above 14,000. It's not legitimate. The chart has to go down and retest 14,000 legitimately this time around. But if you are curious about how we got the line above the resistance line, here it is. It is 14,445 exactly. And the chart is a mess because it has all the markings that we've done throughout the years, but I'm going to highlight it for you. Here it is. You can see that this is an important level of support and resistance. So this is going to be really hard for the Qs to crack above. We look at the 30 minutes chart for the IWM, the Russell 2000. What do we see here? Above 174.22. If it closes above this number, we're bullish. Closes below it, we're bearish. Right now, it managed to close above, and I have to point out the obvious for you. It could be a reverse head and shoulder formation. And if it is, we could see the IWM going higher to close the gap at around 178. We'll see what happens after that. But if the chart flushes down right away and it loses 174.22, the safe assumption would be it's going to go down in a retest of 168.90. Now, if you're hoping for the rotation from the winners to the losers to the cyclical side of the economy, this gives you a little bit of hope, the reverse head and shoulder formation, that we could see money coming out of the Qs and chasing the IWM. So keep an eye for that. How about the dollar index? We looked at the 4 hours chart in the previous video. Part number 1 of this analysis, negative divergence, getting really toppy right now. I would not be surprised to see a pullback even all the way back to 103. And if that happens, it would be good for what? It would be good for gold. Gold is not oversold yet. 1928 is an important number. Let's see how it reacts. But you're not going to have a confirmation that you got a legitimate bottoming process at the beginning of a move higher in gold until you see the Dixie cooling down, and preferably along with yields, unless we see a legitimate reversal, which I don't see happening. I see pullbacks, but I don't see reversals yet. And the same goes for silver. You can see that silver is already overbought, unlike gold, the SLV, so it caught a rebound on Friday. Now we need to see it climbing above 21.57. This is an important number. It's going to be stiff resistance, but if it cracks above, that would be a good sign. If we indeed get the dollar pulling back, it would be a good sign for at least a trade in buying SLV. We look at oil, Brent oil, a daily chart. What do we see here? It closed exactly at 77. The bulls want to see a crack above 77, at least with a decisive close, let's say at 80, for example. For now, the good news is the RSI remains in positive divergence, so is the MACD. But the problem is, what if this is a giant bear flag consolidation pattern? If it is, we lose the double bottom. You gotta get out of energy. Here's the daily chart for the 2-year yield. We talked about it in the previous video, part number 1 of this analysis, but here it is again. Close the gap, getting really overstretched in the daily. We need to see a pullback, maybe going all the way back in a retest of the consolidation range, the top of the consolidation range, let's say at around 4.3. And if that happens, we will see gold rebounding. We will see perhaps the IYR real estate rebounding, the high dividend paying names rebounding. But then watch out if the 2-year starts to rebound as we head closer to the Fed meeting, because then you want to book profits on those trades and move on. Because we look at the weekly chart, once again, this could be a bullish breakout. Whatever pullbacks we get, it's just a matter of time before this chart moves higher, and it wants to move higher. For now, there's no stop to this inflation, and the Fed will have to do a lot more. We'll look at the TLT weekly chart, breaking below the pattern, negative divergences, not liking it here, but again, if the 10-year pulls back as a result of the debt ceiling deal, works out some overstretched conditions on the daily chart, we could see the TLT even climbing the trend line once again, but don't get too excited about it. Look at the VIX 4 hours chart. What do we see here? It closed pretty much exactly at 18. That keeps the mystery alive. VIX bulls would say this is still an ABC pattern in the making. VIX bears would say it didn't happen. 20 is really too sticky for resistance. The VIX cannot make it above 20, and now it lost 18. It lost the positive divergence of the RSI. It is showing bearish momentum in the MACD. What more do you need to see? That the VIX is going down. It might go down and retest 17, but my hunch is, as we see the reversal in the Qs happening, it could happen this week, it could happen next week. As we look at the weekly charts, if the RSIs become really hot, they're going to be due for a pullback and the VIX is going to pop and make it above 20. But watch out for this chart, Apple, the big kahuna. It has been silent for a little while, not doing anything at all, not being involved in the AI mania. And if you're a money manager right now and your clients say, hey, you got to buy some big caps, you got to buy some AI mania names. And you say, hey, clients, do you really want to buy at the top of NVIDIA? Do you really want to chase AMD and Google and Meta? Are you out of your mind? The client will tell you, I don't care. Like Elon Musk, I don't care. Get me into something related to AI because I have FOMO. You know what the managers would do? They would buy Apple because they would say, okay, Apple is safe. It has been the laggard. Maybe it needs to catch up. We look at the chart. It is forming a bull flag pattern. It's not overbought at all. We look at the weekly chart. Similar story. Not overbought. Bullish breakout. Nothing bearish here. If it breaks below the trend line, then we can talk. But right now, it is bullish and it's safe for many managers to buy. And therefore, I could see Apple moving higher to even 180. And the bears, of course, would say, if you look at the monthly chart, this could be a false breakout. And then we go down and trade within the bearish channel and make lower lows and lower highs. That could be the case. But right now, do you have a confirmation? You don't have the confirmation until the chart is back into the channel. Right now, you leave it alone. If you happen to be a money manager, it could be a safe pick for your clients, at least for now, for them to stop crying. Let them make a few bucks, maybe the 180, then get them out. And then we look at Tesla on hourly chart. What do we see here? The good news is, at least for the bulls, they got a higher high. The bad news is, the majority of these pops are happening due to gamma squeezes using options. Options have expiration dates, and the majority of these people chasing Tesla are using weekly expiration options. So this is not sustainable here. But the most important number is 180. Tesla bulls, you don't want to lose 180 once again. Of course, the bullish scenario is that this is a pullback in an ABC pattern, and higher we go all the way to 200. But then you look at the weekly chart. It is a battlefield. The MACD right now shows bullish momentum, but is it decisive? The answer is not quite. Until we get to 200. Then we're talking. Sure, the bulls have a pattern, which is a cup and handle pattern, my favorite, which could support Tesla going higher. But the problem is, the bearish outlook says, all what we've done is we went down to a sticky support zone. We got the pop, consolidating for a little while. Tesla runs out of steam. It goes back into the sticky support and it stays there for a little while before breaking down. Now, for all of you who want to bet against the NASDAQ, is it time, Maverick, to short the Qs? You gotta look at the individual names. You gotta see all of them, at least the majority of them, becoming really overbought on the weekly charts. I repeat, on the weekly charts. Apple is not overbought. Amazon, not quite yet. If it goes all the way to 129, then it will, and that would be sticky resistance, so that would be a safe place to short at least Amazon. We'll look at Google weekly chart. Sure, way overextended on the daily chart, and we got a pullback, a decent one, not all the way to 117. But it was a good options play. You look at the weekly chart, it's not really overbought yet. It can go a little hotter. How hot can it go, Maverick? Believe it or not, 133.29, which is a gap above. Is it crazy? Yes. But is it possible? Absolutely. Then you look at Meta. This is a weekly chart. Okay, this is due. This is way overbought. So Meta is the weakest link among the bunch. But you gotta see Google, you gotta see Amazon, you gotta see Microsoft and Apple also becoming really overbought before we start shorting the NASDAQ. The good news is, you look at Microsoft, it is becoming really overbought. Can it go all the way to close the double top formation? Yes, it can. So if we look at it all in all, we got Microsoft, we got Meta, those are due for a pullback. Those are getting really overbought. Amazon, Google, maybe a little more. Apple is the one that should really scare the shorts because it has been doing nothing at all. And if Apple starts to move higher, the sheer weight of Apple will keep the Qs intact and crush your put options. So you gotta watch for all of them. It's not a requirement that all of them become severely overbought, but at least the majority have to. Bitcoin, tulips, daily chart, what do we see here? The negative divergence in the RSI is now positive. The MACD is also showing positive momentum. Now, if I'm right and the dollar pulls back, it could be good for Bitcoin too. So keep the hedges, whatever hedges you got, at 26,555, because for all you know, Bitcoin could go down and crash right away. It is unpredictable. But right now, we also got solid indicators that we could see a breakout above the consolidation zone. But I would say it is contingent on the dollar going down. And then let's look at some other charts, international charts. What about the DAX? The German DAX monthly chart, what do we see here? I don't like this at all. The German economy is weak. It is officially in a recession. And people are buying it. Negative divergence to the RSI, double top, weak momentum in the MACD. I don't like it. Now here's another chart, international market, that I do like, unlike the DAX. It's the Japanese Nikkei. Monthly chart, bullish breakout, above the trend, firming RSI, firming MACD, much better looking than the DAX, much better looking than the Chinese market, the Dow Jones, the Nasdaq, the S&P. I'm not saying it's going to go to the moon right away. We're going to see pullbacks. But if I had to bet, if somebody says, here's $1 million, Maverick, you got to buy right now, this moment. We don't care what happens next. Do you buy the Nasdaq or the S&P or the Nikkei? I'd go with the Nikkei. And then here's another chart that everybody's talking about, a daily chart for the ticker TGT, Target. It is involved in a controversy. We don't need to talk about it right now, but it is way, way, way oversold. Should we at least catch a rebound? The answer is yes. Do you have to care about the controversy? Yes. But when charts get really, really oversold like this, when we talk about Bud Light, for example, there is a substitute in Coors Light. Target is a unique store, and people can talk about boycotts all they want. At the end of the day, you gotta shop at Target. And right now, the chart is giving you a cheaper entry price. I'm not saying buy it as an investment. I say maybe you want to trade it to close the gap at around 150. That's all. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Tomorrow, the 30th, we have the Case-Shiller Home Index, along with consumer confidence, and then we have from Richmond, Fed President Barkin. Wednesday, the 31st, we have the ADP employment report. We have job openings, along with the Chicago Business Barometer. We also have Philly Fed President Harker. He used to be hawkish, now he flipped. Let's see what he got to say. And we also have the Federal Reserve Beige Book. Thursday, June 1st, we have initial jobless claims, manufacturing PMI, construction spending, and day number 2 with Harker from Philadelphia. Finally, Friday, June 2nd, we have the big one. The employment report comes with the unemployment rate, and most importantly, hourly wages. Interesting week. Once again, if you did not catch up on part number 1, please do. It was a valuable conversation. I put a lot of effort into it, so please watch that video. And again, a reminder, I'm going to be off tomorrow. I'm going to work on the portfolio reviews for the Top Gun Mavericks and the pitcher reviews on Discord. And the reason is my father-in-law is visiting, so I want to spend a little bit of time with him, get him stoned a little bit, maybe take him to a strip club. I'm that kind of son-in-law. But a reminder, he was a legendary trader and investor back in the day, so I might have to interview him for you guys. Let's see what he has to say about this stock market. He made legendary trades back in the 70s. But anyhow, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again if you happen to be a member of the channel tomorrow. Otherwise, Wednesday. Good night.
I'm breaking down.